There are two fundamental different types of edges in short-term trading. And the vast majority of the time, traders are trading on price action. I would say somewhere between 80 or 90% of the time. But occasionally, short-term traders will have an informational edge. And it's important because on an informational edge, you sometimes will go against the price action and you will be willing to draw down more, risk more money when you have an informational edge. My name's Steve Spencer. I've been trading for over 20 years. I'm a partner at a proprietary trading firm in New York City, SMB Capital, where we specialize in training traders how to trade stocks, futures, and options from scratch. And if you're interested in more in-depth education on what we talk about in today's video, please check out our 2-hour free workshop. Today's video, two types of trading edge: price action, informational edge. Price action is a thing that we talk about in most videos and other traders talk about videos. It really is understanding the supply and demand in a stock, understanding if buyers are in control, sellers are in control. Most times, the vast majority of the time, as short-term traders, we want to be long when buyers are in control, when the price action is showing us that a stock is a good long and moving to higher prices, and we have very specific ways that we're analyzing price action, and vice versa. We want to be short when sellers are in control and the price action shows us that we should be short. Occasionally, we get a piece of information on a stock that tells us that we want to be long that stock. And we might have price action that's going against that, or we might have information that tells us we want to be short a stock, and the price action says be long. But because of that informational edge that we've developed, that information that we possess, we're going to go against that and understand that even the price action going against that information in the short run will perhaps even give us better prices to establish a larger position for that in the direction of that informational edge. And so that informational edge, we're going to put on more risk. If normally you might risk on a trade $1,000, when you have informational edge, you might risk $3,000 or $5,000 or maybe perhaps even $10,000 depending on how good that information is. And a couple of things to notice about a couple of things. Number one, that's important. On that informational edge, generally you want the market at large not to have that information or not to be thinking about that information. Otherwise, you won't have great prices to get involved. Let me give you a few examples of what I consider informational edge trades. Every once in a while, you'll know that there's going to be a large order coming into a stock through a variety of sources. And what do I consider a large order? If a stock trades 1 million shares a day, and you know that somebody is going to be buying or selling 500,000 shares, that's big. 50% of the average daily volume for the day. If you know that somebody's going to be coming into the marketplace and they need to get out of a trade, it doesn't happen that often, but every once in a while you get that information. That's pretty good. Meaning, like if the stock is strong, but you know that someone's going to come in with 500,000 shares to sell at some point later in the day or the next day for whatever reason, that's really good information. Doesn't happen often, but that's an example of it. Here's a more common example of an informational edge. PR release. Company comes out with a PR release. They like to plug something, new product, new contract, whatever, but they actually did the PR release a month before, 3 months before, or 6 months before. Sometimes they'll do for whatever reason, they'll release the same information again, or it gets filed. Here's an example. They released it to the news services back on May 1st, and then it becomes part of their filing on July 1st. And people think, oh, they got this new contract. No, they didn't get this new contract. They just filed their quarterly report, and people see that, and they're bidding the price of the stock up in the pre-market. And you know, because you do your due diligence, oh, they did that press release on May 1st. They're now just putting it as part of their official SEC filing. If it's jumping up to kind of where it jumped up a couple of months ago, this is going to be a great short and you're going to risk a lot of money. Another one is sometimes a stock will run up, like a $1 or $2 stock will run up to $4 or $5, $6, $8 on some good news. And within a couple of days, especially in the biotechs, they'll file a secondary. What does that mean? They'll file for more shares to raise money. It's quite common on our desk for people to kind of short into that news, and then when the news comes out, add to those positions. That's another example of informational edge. And then finally, here's another rare example. I'm not going to even give you a specific example of this one, but it happens every once in a while where a company they'll have an asset. They'll actually do a deal where they sell part of the company, and then they get something, they have a particular asset or a liability that they get rid of, and you can spot that, and you can actually spot it in a filing with the SEC. Most people don't realize that they have that. I haven't seen actually this one in a while, but every once in a while, a deal will happen, an announcement will be made, and there's some asset that the market's not pricing in, and if you do your research, you do your research on Bloomberg or your news services, and you find out what that asset is worth, X number of dollars a share, and it's not being priced in, that's something where there's an informational edge, and you'll put on a lot more risk. And so these are really rare. As I said at the top of the video, 80 to 90% of the time, we come up with a thesis, there's some good news, company raises guidance, they lower guidance, and then we're looking for price action confirmation. That's 80 to 90% of the time. So I'm going to give you a couple of examples of what that looks like. And I'll give you an example of kind of what I would consider an example of an informational edge as well. And the really important thing is I'm going to show you two just normal reported earnings. One was positive, one guided up, one was kind of negative, one guided down. You need to understand that when you have the kind of the normal information comes out and is widely disseminated and everyone knows it, you need price action confirmation. And so if let's just look at the examples. The first example is UAL. They came out with good earnings, they guided higher. And so you can kind of see I left the markup here. This is from our morning meeting. And I highlighted kind of the resistance area, the reaction in the pre-market. And then this is what happened when the market opened. It went through our resistance area, went up to the next longer term resistance. You can see that's the top blue line. And that's confirmation of kind of the news, the initial bias, they guided higher. That's fine. If you came in with a long bias and you saw it get above that pre-market high and you were long and you were trading it to that top blue line, fine. And then the next day was actually a second day play for long again and it followed through. That's great. What you want to do is avoid the second example, actually Netflix, is we came in with a short bias because it had traded up since last quarter about $100 from 300 to 400. It had doubled this year. And some news came out where they missed their subscriber numbers, they guided down. And so we see the initial reaction, this is actually the pre-market, the initial reaction was it dropped from 400 to 340. In the after hours, we came in the next morning, and in the pre-market, you can see, again, I left all the price levels in there because I want you to see exactly what it would look like if Netflix was behaving like a good short the next morning when the market opened. And so here are the notes. We have the after hours support was around 342, 342.50. I had 345 as my S2 level. And basically what I want to see when a stock like this is down $40 or $50 is I want to see it get below support 2, and I want to see it take out the after hours low. When the market opens, below those levels. And if it bounces a little bit back into those levels, fine. But as long as it's below 350, it can go down $15, $20, something like that to longer term support. Well, the exact opposite happened. And the reason I'm using this as an example is we did not have informational edge here. We had a stock that had run up a lot into earnings. We had a stock with negative news. And our expectation would be if people were panicking out of it, it's going to take out the after hours low. It's going to do all sorts of things in terms of the price action going to lower prices. What is the first thing it does? It does actually drop a little bit. You can kind of see where I highlighted that little kind of last blue support area, but it touches it twice, and then you see big green bar. No big red bar, big green bar. And on the notes, you can kind of see I have 350, I think, as inflection, meaning if it gets above 350, it can bounce to the after hours high to 360. And if it's below 350, it can go down to the support areas we highlighted. Right on the open, it's below the 350, so if people are shorted, that's fine. We want to see what happens in those supports. It actually holds there, and then it gets above 350, and so we have to be a little bit cautious on the short. And then it gets above our first resistance area, which was 52.5, something like that, 51.5, 52. and then it goes basically straight up to the pre-market high, comes back down, gets above it, comes back down to it, tests, and then trends up. I'm not even showing you the rest of the day. It went up like another $15, $20, something like that. But this is a really good example. Bad news, bad guidance, you have some levels, it holds the support levels on the open, gets above your resistance levels, gets you above your next resistance levels. Pretty much you don't see any type of pullback until it gets all the way above the pre-market high, and then this is a stock from a price action perspective is behaving as a long. So if you came in with a short bias, fine. If you held it as a short until it took out 52 or even above 56 or whatever, fine. But if you kept on shorting it when the price action just said long, 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 just in the first 30 to 45 minutes, that would be wrong, and you really don't want to lose that much money in that situation. You want to lose money, or you want to risk a lot of money when you have an informational edge. So here's the next example of a stock that there's some informational edge. It's a stock, a biotech, AXON, a couple of months ago, came out with really bad news. Their drug didn't work. It had been $20. It gapped down, then some more bad news. Basically, it was looking like it was going to go out of business. It was down to $1 a share. And they got financing to license another drug. They got financing of $30 million. And so this is a stock that has 100 million shares outstanding. So it cost them about 30 cents per share to get this financing. And then we come in the next morning. Here's the headline, actually: gains on licensing deal with Oxford Biomedica. So they're not out of business. Somebody gave them $30 million in financing. When you license a drug for $30 million, generally, the company that's licensing it to you, it's worth about $30 million. If it becomes successful in a couple of years and gets approved, maybe it'll be worth more than that. But what it was worth was about 30 cents a share. Now the stock's beaten down to $1, so maybe it could trade back up to $2 on that news. In this case, the stock actually traded up from $2 to $5. And there's some structural reasons for that. Actually, as I said, there's 100 million shares and people saw it was beating down, so they were probably trying to short it at $2.50, $3, $4, whatever. But if somebody on my desk came to me, one of the more experienced traders, and said, hey, they just licensed a drug, this doesn't change anything fundamentally, at $4, they wanted to start to build a large short position, because they first finally saw a pullback, I would say fine, and I'd say understand, the buyers really are in control right now. This might take a couple of days to top out. Do I eventually think it's going to go back down to $2? Yes, but from a price action standpoint right now, the trade isn't working. But there's informational edge there. What happened was the next day the stock gapped up. It got down below $5 eventually the next day, and then trended down over the next few weeks down to $2 a share. So this is an example of something I'd be willing to lose more money against the price action, but understanding that when the price action finally gets in my favor, that's the time to really press and really push for a move all the way back down to where it started from. One final note, I wanted to just say that if your thesis on Netflix doesn't work, and again, 2 or 3 people got caught on this, hurt on this, because rightfully so, they had a short bias based on the news, the guidance, all of these things that had run up a lot, but probably for that reason, that's probably why it ran up on day 1. If we look at it on day 3, I just wanted to give you a little postscript on the Netflix trade. Day 1, it went all the way up to 385, pulled back to the mid 370s, held there. On day 2, it actually consolidated between like 373 and 382 or so. And then on day 3, it started to show weakness in the morning. And you can kind of see I highlighted the support from day 1 afternoon, the low from day 2. And if you thought eventually the stock was going to get back down to 340, 350, maybe even go lower, you could have just waited for the price action confirmation. And that's what we got today. And that's what some of the better traders on the desk did when it actually got below this morning. When it got below day 2's low, they started to look at it on the short side. And it's been trending down since. I have no idea where it is right now, end of the day. But this is a stock that's now the sellers are starting to take control again, and perhaps this will come all the way back down where it started from on day 1. So the market always gives you another chance, and it's very important to understand that before the market opens, and I've said this in other videos before, have a fully developed plan. Understand you can have a thesis based on a catalyst, good earnings, bad earnings, fine. That whatever the case may be. But if you don't have an informational edge, if there isn't some sort of information you know that most of the market participants don't know, and eventually when other market participants find out, you know the stock is going to get crushed or go up because there's some unknown asset people don't realize that was in an SEC filing, you've got to go with the price action. You've got to understand what does it look like when the trade is working, and that's part of your trading plan before the market even opens. And have a process for your stock selection. Have a process to have your game plan, to have a detailed trade plan, and then understand once the market opens at 9:30 and the bell starts, have your checklist ready to go. Did I see the first thing I needed to see for this trade to be working, the second thing, the third thing, etc. And that's how you're going to be consistent when you look back at the end of the week or the end of the month. If you have the process in place, that's how you're going to be consistent in your results. And understand, most of the time you don't have an informational edge, 80 to 90% of the time. If you want to understand more about the stock selection process in detail, as well as 2 detailed trading setups, check out the 2-hour workshop that I do with myself and Mike Bellafiore. Click on the link, take you to the sign up. If you enjoyed this video, I think you'll really enjoy the workshop.